It's the importance of the exit using the Fibonacci's. Once again, I'm Dale Brethauer. I've been trading for 35 plus years. I do this for a living. I also run a hedge fund, the Options Infinity Growth Fund, and we've started a stock education website, www.optionsinfinity.com, and I'll be talking to you a little bit about that a little later on. Let's see, today what I want to talk about is, when do you exit? When do you exit? When is enough enough? You know, the old adage is you want to cut your losses short and let your profits run. Well, how do you know? How do you know when it's time to take your profits? We're going to be talking about the measured moves, and Anka's talked a little bit about that. Going to be going into more detail on that. What are the Fibonacci ratios and how were they developed? How were they developed? I think you need to have the basis for the Fibonacci's to fully appreciate their power. I like to go at the Fibonacci extensions, the way overextended 161 and 261. You can use this in any time frame. I'm going to show some trade examples, some actual trades, and then we're going to talk about my trading record. Okay, Frank is saying, let's see, the other thing is, as we go through here, if you have any questions, I've got my question box opened. If you want to ask a question as we're going through, I will be monitoring this. I'd rather answer it while your question is fresh in your mind, so you can, you don't sit there and think about your question while I'm proceeding through my discussion. Okay, so just type it in the question box and I will respond to it. Most all stock market literature discusses the trade entry. 95% of the literature out there, the websites, the books, the DVDs, they're all talking about when to get into a trade, what you're looking for. And really, I think the trade exit is the most important part. I could almost go ahead and predict that I'll do better with a random entry and exiting with the Fibonacci's and the rules that I use. As I mentioned earlier, the old adage, cut your losses short and let your profits run. With the Fibonacci's, you will be able to target when you've had enough, when the profits have run and they're about ready to consolidate or pull back a little bit. Now let's just take a quick look at some of the common ways people exit. And I'm just picking a couple three here. You can look at a MACD crossover. Some people like a trailing stop. Anka was talking about the moving average, a certain day moving average. All those are fine, but they don't necessarily maximize the profit potential of a move. This is a McDonald's chart way back in May of 13. Let's say we entered right here, okay? Now, there's three exit points right here. One is looking at a trailing stop. The other is hitting an exponential moving average line. The other is looking at a MACD crossover. And notice they all cluster right around here. Was that the right time to exit that? Well, if you take a look at the next chart, that was a good time. I mean, when you entered at let's say you had a March 80 call at 10:18. Each one of these gave you a very nice profit. Very nice profit. But did you let your profits run? And when was it time to get out? Using the Fibonacci extensions or retracements, you can take profits on the upswing. Take profits on the upswing. And the first concept you want to learn and go over is a measured move. And let me look at the right-hand side first. A measured move is, let's say the market is in an uptrend, and that is higher highs and higher lows. Higher highs, higher lows, higher highs. Whoops, okay. Lower highs, lower lows. That's the classic definition of a downtrend. It is called a measured move. It's a low followed by a lower high and a lower low. Right there, you can use a Fibonacci extension and project when it might be a good time to take profits. Now this is on the downside. Let's take a look on the upside. Let's say we're coming down here and we're making lower lows, and then all of a sudden we come up, it pulls back, it makes a higher low, then a higher high. This is a measured move to the upside. When you have a measured move, you can put on a Fibonacci extension to target when you might see some consolidation, when it might be a good time to exit the trade. I use Fibonacci retracements when I've got double tops and double bottoms. This is a double top. Now remember, a double top is not confirmed until it goes past this point right here. It goes past the low right here. This is then a confirmed double top. This W is a confirmed double bottom. When you have something like that, you can put on a Fibonacci retracement and look to see where a projected exit might be. Now, one other point. It's better, especially if you're trading options, it's better to get out of the trade when it's still going in the direction of your position. If you have a call, you want to exit it as the stock is still moving to the upside. Vice versa on the downside, if you have a put, you want to exit while it's still going down. An example here is this particular stock came up to the 261 and then came back here and pulled back to a measured move, or not a measured move, to an exponential moving average line here. This is the same chart we were looking at earlier. We're here with the exits here. Getting out here is way more profitable than getting out here. Okay, getting out on the upswing is way more profitable than having it turn around. Fibonacci's allow you to get out while it's still moving in your direction. Now, this was our entry, and you'll notice that it came up and made a higher low right here, and then it gapped through a higher high right here. At that point in time, you can put on Fibonacci extensions and Fibonacci retracements. Fibonacci extensions, the ones I like to look at are 100%, the 127, the 161.8, and the 261.8. And you'll notice that at every one of those, you usually have a little bit of a pullback or a consolidation before it kicks up and goes further. Notice it came up here to the 100, consolidated, pulled back a little bit, hit off the moving average line, and up it went. Blew through the 127, came up to the 161, sat there for a while, had its final push to the 261. You could have gotten out right here. This would have been an excellent exit. And you compare that versus early on exiting. Okay, you're allowing the trade to evolve. You've got to allow the trade to evolve. But then, when is it a good time to take that profit? And that's what the Fibonacci's will tell you. I love, again, the 127, the 161, and the 261. This 161 and 261 were put on because this made a double bottom. Doesn't have to be, okay? But a double bottom, when you have that, you can put on Fibonacci extensions, and notice how they jive with Fibonacci retracements, and Fibonacci extensions jive together. Okay? You can see it consolidating here and then pushing on up. All right. Now, with that trade on McDonald's, the other ones returned, between 28 and 36%, which is awesome. Exit based on the Fibonacci retracement and extension on January 20th returned 114%. 114%. Let's see, John says, how would you protect the profits on McDonald's if it had continued down rather than resumed an uptrend? Let me go back to that, John. Back here, I'm thinking you're probably thinking right around here. Well, this is a great stop, okay? This is a great stop. I'm not saying these Fibonacci's are 100%. There is nothing in this environment that we love to play in that works 100% of the time. If you get a strategy that works 60% of the time and gives you a greater return than when you have a loss, you have a positive expectation strategy, and guess what your job is then? Do it. Anytime it presents itself, you just do it, do it, do it, do it, do it. Because you have a positive expectation. Yeah, you're going to have losers, John. I'm the first to admit you're going to have losers. I have losers. Okay? I embrace losers because I know that there's a winner right around the corner, and when I have a winner, it's going to produce more than what I have when I had a loser. Now, I don't use stops myself. I use visual stops. This is a visual stop for me. Okay, and I'm looking for a close maybe below this line. That's a visual stop. I've gotten stopped out way too many times in my trading career. And I'm not going to say what the floor traders do and all that kind of stuff, but a visual, knowing what your exit plan is before you go in is a key. And that's what the Fibonacci's and a moving average line combination do for you. You know when you've had enough, when the trade hasn't produced what you thought it would be, and you jump out, and you know when you've had enough profit, and then you take that and jump out. Excellent question, John. Let's talk a little bit more about Fibonacci ratio. It's commonly seen throughout nature. If you look at the stem of a flower, now it's getting spring, even though we're supposed to get some snow here on Friday on the East Coast. We are getting close to spring, and if you go out and take a look at the stem of a flower, the leaves on that stem grow at a proportional distance to the Fibonacci ratio, which I'll show you in a second. It's called the golden ratio. The spirals on a seashell are in proportion to the golden ratio. The distance of your forearm to your hand is proportional to the ratio. My hand is 7.5 inches. My forearm is 12.3 inches. You divide my hand by my forearm and it's 0.61. 0.61. That is the golden ratio. What's interesting about that is most of your major bones are also proportional to the golden ratio, etc., etc. Now, if the Fibonacci ratio is seen throughout nature, doesn't it make perfect sense that the market would move in perfect harmony with that? drives the market? Human nature, fear, and greed. Okay, this is bringing another arrow into the quiver that you have of tools to use on the market. And this is basically saying, I'm going to use the fear and greed of the traders, and yeah, the institutions have it too, to my advantage. I'm going to use human nature to my advantage. And the Fibonacci ratio is seen throughout nature. Okay, what is the Fibonacci ratio, the golden ratio, and how's it derived? Way back when, Fibonacci came up with a number sequence, and that number sequence was derived by taking 0, 1, and then adding the 2 together to come up with the third, and then adding the last 2 together to come up with the fourth, and then adding the last 2 together to come up with the fifth, and so on and so on. This is the Fibonacci number sequence. Now, before I move off the number sequence, I want to say that first of all, I look at not an exponential moving average line. I look at an exponential moving average ribbon, and I look at the 5, 8, and 13 day exponential moving average ribbon. Anko was talking about, the 20-day, that a lot of the institutions follow the 20-day. That's the next one in the Fibonacci sequence. Makes sense. Okay, now if you take any one of these numbers and divide it by the following number, you will get 0.618. It's called the root Fibonacci ratio, or the golden ratio. Then mathematicians took this and they said, well, what's that squared? And what's that the square root of that? And those are the retracement numbers, remember? 0.382, 0.786, and right in the middle, 0.618. You use those for retracements. I like to look at the extensions, which is the reciprocal of these numbers. 1 divided by these numbers. The big one is 2.618, 1.618, 1.272. These are overextended trades. It's good time to take profit. You'll see it rebound off here a lot of times, and possibly push up to here, rebound off here, and push up to here. These are excellent points to take profit. Excellent points to take profit. Well, let's just take a look at a couple of these, and let's talk about exiting at the 261 Fibonacci extension. This is a trade I had in GDX. This was the ETF, GDX, the Gold Miners ETF, and you can see that it came down here and pulled up, and then overnight it dropped down. You say, well, how low is it going to drop? That's a measured move to the downside. You put on the 161 and the 261. Can you see how close that is? Okay. The Fibonacci extension was 36.56, and that's where it came down and hit within a tick. Came back, hit there in a tick, pulled up, came back, made a double bottom here at the same point, and went up. The more you do these, and I behoove you to play with these and try them for a while, to prove to yourself the accuracy, it's going to blow you away. I've had many trades come to within a tick and hit that and go in the opposite. What causes that? Human nature, fear, greed. Okay, you see it time and time again. This trade in GDX, getting in right here on the opening and taking it down here, yielded 136% in a little bit more than a day. You had to hold that overnight to catch the next day. Now, Fibonacci retracements and extensions may be used on any time frame, any market, any movement, up or down. It's about the most flexible tool you've got. Joy, I'll talk about that. Joy wants to know if there's a special tool that you use. And, well, let me answer that for you right now, Joy. I use Thinkorswim. I'm not affiliated with Thinkorswim. I think they happen to have one of the best trading platforms out there. But and I use, it's so easy to use. All you do is come up here to the drawing tool, okay? And on the drawing tool, first of all, I want to put in the trend lines, and here's the Fibonacci retracement, and here's the Fibonacci extensions. So let me put this in for you, Joy. And this was today's move on the FOMC. And by the way, I think we've got a little bit more to go, maybe tomorrow, and then I think it might be played out. Although we were pretty close to it today, and an astute trader might have jumped out right here at 2:30 and said, thank you very much, that's close enough. I've got a huge move that was projected here on this Fibonacci measured move down here. Okay, Joy, you take a measured move, and that is a higher low, and notice this was very close to a double bottom, and then a higher high. That is a measured move. Once you have that, you can come up here to the Fibonacci extension. You go back here, you click once, you drag it up here, you click twice, and you drag it down here, and you click 3 times, and it automatically puts that in. I have it so that it shows just the 127, the 161, and the 261. Now, this being so close to a double bottom, you can also put on a retracement, and that is from going to the top portion of the W on down here, and going ahead and looking at the 261, the 161, and there they are. Okay, and that's how easy it is to put those on. Okay, excellent, excellent. Okay. So let me give you some examples. Let me show you some examples in the different, what we're going to do is look at a weekly chart of Verizon. We're going to look at a daily chart of a Forex. We're going to look at an hourly chart of silver. We're going to look at 5 minutes on the financial ETF, the financial banks ETF. Here's a Verizon weekly chart. And this was a measured move that was made way back here towards the end of 2013. Measured move right here. If you would have got in right here, it would have come up to the 100. You know it's going to pull back or consolidate a little bit. You hold on. It pushes up to the 161 and has a little trouble there. Finally, it gets up. This is a great time to get out. This is a great time to get out. If you didn't get out there, it gave you another chance to get out right up here. Okay, that's a weekly chart. That's a huge move that you had a target for when to get out. Here's a Forex daily chart, and here's the measured move. Okay, see, it was coming down, measured move to the downside, and then it comes up, makes a higher low, and then a measured move, and there's the 261. Look what happens once it hits the 261. It's pretty close right there, isn't it? And then zoop, down it goes. Okay, that's the weekly chart. That's the daily chart. Here's the hourly chart. Okay, this is silver. Comes down here, makes a lower high, makes a measured move over here, and in about 5 days, it comes all the way down to the 261. Now you say, well, you know, why not get out here? Absolutely. If you're a more conservative trader and you want to take profits at the 161, that's fine. I do that a lot of times. You know, if you get a nice move, especially on a weekly option or something like that, and it comes down to the 161, take it. Jeff, I will do that. Jeff wants me to just go over how I did that on Thinkorswim again, and I'd be glad to do that. I'm going to show you some more charts on TOS in a second, so I'll come right back to that, Jeff. And then here's a 5-minute chart. Well, does it work on the 5-minute chart? Well, doggone right it does. Here's a measured move to the downside. Okay, you get in right here. Okay, here's the 100. It comes down to the 100. What happens? Bounces off there. Comes down and blows through the 127. Comes down to the 161. Now, this is a 5-minute chart. This is the end of the day. Doesn't it make sense to take that profit in an hour and a half of trading? It just does to me, and that's where the 161 came into play on the 5-minute chart. Okay, let's go over some actual trades. There's a number of strategies that I follow. I think it's good to not only have a diverse portfolio, but a diverse strategies you use. One is I have directional calls and puts that I follow. The other is I sell premium and basically looking at the RUT. This is an iron condor that we had on, and I knew that I was in good shape with that iron condor based on the Fibonacci's. Here's a weekly option in the FAS, and then we'll trade stock. Most of my portfolio in my hedge fund and my personal account is in stock. Stock, you don't have the time constraints. You've got dividends. If you have a large amount of money in your portfolio, you don't need a huge percent return to make a nice, handsome living in the stock market. Okay. How do you know at what point on the charts to set this up, Enos? I will show you that in a second when I bring up the Thinkorswim. Okay, this is Microsoft, and this was a measured move that occurred right here. It came up and it blew up to the 161, pulled back, and then pushed up to the 261. Would it have been okay to take profit here? Absolutely, absolutely. Notice the 20-day exponential moving average line. Okay, when you're in an uptrend, this is an excellent thing to use as a stop loss. Very seldom, you know, I call it like a trampoline. It'll come down and it'll bounce off there. Boom, just like a trampoline. Boom, in an uptrend. Same thing's true in a downtrend. Okay, now selling premium. We had an iron condor on the RUT, and I had the call portion, the bear call up here, and I wanted to know if I was okay or whether I needed to jump out of that. And I knew that it was going to come up here and hit the 161 based on the measured move all the way back here. You know, it came up to 100, consolidated to 127, pulled back, came up to the 161, and just stayed right there. Okay? That iron condor returned 12% in a month. And you say, well, 12% is a lot. But I put a lot of money on the iron condors because you need that for margin. And like I said, when you're in stock and when you're selling premium, you don't need that big return. Although 12% in a month isn't too bad. It's nothing to sneeze at. Here's a weekly option on the FAS, and this was due to the unemployment report. There's two things that I really trade, and I know a lot of people stay away from the FOMC, and a lot of people stay away from the unemployment report. I love to put on strangle positions for both of those, because most times you get a very violent reaction. This was an unemployment report in May of last year. And what you want to do is you want to put on a strangle position just before the market closes, because at 8:30 the unemployment report comes out. It was a pretty bullish unemployment report, and even before the market opened, I had made a huge percent return on this guy right here. Now remember, I had both the call and the put. The put is part of doing business. That's a cost of doing business. And then here's just how I use it with stock. There's a couple more things you see on my chart here. One is, this is the regression channel. The regression channel, I think, is excellent as far as knowing what's overbought and oversold. Okay, this is like, statistically, this is plus or minus 1 standard deviation. This is plus or minus 2. Okay, 68% of all prices will be contained within plus or minus 1. 95% of all prices will be contained within plus or minus 2. It's a great place to know when to get long or get short. Okay, and here's a measured move on McDonald's, and I took McDonald's on up here, and you know, at the 127, I knew it had more room to run. How did I know that? Well, it was right in the middle of the regression channel, and it ran all the way up here, plus over the +1, and almost got very close to the 261, and right around here I said, that's great, that's fine, I'm going to take that and get out. Joy wants to know one more time how to go over that measure move, and I will do that click by click for you in just a sec. Just a sec. As a matter of fact, let me do that here before I get over here. We looked at SPY. Let's also look at TLT. Let's take a look at TLT and see what it did today. TLT was in a short-term what? That is an uptrend. That's a higher low, higher low, higher low, higher low, higher low, higher low. Uptrend, uptrend, okay? You can put on a Fibonacci on any one of these moves. And the more you can put on, you start looking for clusters. But let's take a look at that. Let's take a look at the first one here. You go over the drawing tool, you go over Fibonacci extension, you come to the low, and you click once. Then you come up here to the intermediate high, if you will. You click twice. Then you come down to the higher low, and click 3 times. And it puts it in there for you automatically. Well, it's interesting. See how it came up to the 127, pulled back a little bit? I wonder if it predicted this. Let's take a peek. Let's take a peek. Let's take a peek at both the 161 and the 261. 161, 261, bingo, okay? Absolutely. Now, okay, this was done many days ago, so let's look at this one right here. You click right here, so you can do this any place you want. You click, you drag up, and I'm not going to use the overnight data. I'm going to use the trading data, real live trading data, and pull back to its higher low. Okay, and let's go ahead and take a peek at the 161, 261 on there. There's the 161. Is this a nice place to take profit? Absolutely, absolutely. Do I think we have a little bit more to run tomorrow? I do, but not a lot. Not a lot. So you look at this and say, you know, I made a huge profit on that FOMC report today. It's very close to the 261 of this last measured move. You know what? I'm getting out. I'm getting out. You're welcome, Joy. Okay, the work on stocks? Absolutely. Absolutely. Here's a 30-minute stock of Apple, and you can see how this was. You can see measured moves going down. Here's a measured move going down, measured move going down. Then all of a sudden you have a move up and a pullback, and then a higher high. What's that? It's a change of direction. Where's the trend going now? It's going up. Let's put on a Fibonacci. I haven't even done this. Let's do it. Fibonacci extension, and let's go from this point up to this guy right here, and then down to the higher low, and look at the 127. Boom, boom, boom. Okay, beautiful place to take profit if you're trading short term. Okay. Got in late today. Will you be able to get the recording? Reed, I'm almost positive Reed is putting this together and was going to send out the recording to for the whole thing to everybody. I'm almost positive Reed can answer that when he gets back on here. Look at this. There's the 161 on Apple today. All right. Okay. Now, I also used it to get out of Kraft today. Kraft has been going, and let me change my charts over to the daily charts. Kraft, we got into Kraft over here because it was overbought, and we wanted to look for a put. You can see the money flow was going out of there, and you can see how I follow those Fibonacci's down. And here's a nice little cluster down here. Let me blow this up a little bit for you. Let me actually come over here and maximize this, and maybe even bring these guys down here. Here was a 127, and here's a 261. This is clustering, okay? Wouldn't this be a great point to take profit? Let's take it on over here. Okay? What a great point to take profit. Okay? Excellent, excellent. Okay, questions coming through. Could I do this on ES for today? ES. And I'm assuming you're talking about this guy right here. Okay, and absolutely you can see it's coming down, coming down, coming down. That's a measured move right here, and let's do it. Let's do it. So we go down here, first click, second click. Now where do I go for the third one? Do I go here? Nope, I want to come down here. Okay, and that's why I'm saying it has a little bit more room to run here, but in one day that move was I'm out. You know, about 2:30, 3 o'clock, I'm out. I'm going to take that move. Okay, Tim? All right. So that's what I got there. Let me just go over. Last year I did a double up challenge, and that is I take a $25,000 portfolio and try to double it up in a year using two strategies. One is the selling premium, and the other is straight directional calls and puts. And you can see the results at the end of the year returned 151.4% return. And these were all trades that were released on my nightly blog. Every night, you're welcome, Tim. Every night I do a nightly blog that talks about what I see tomorrow. I always talk about the setups for the trades tomorrow. I always talk about the Fibonacci's and when we want to get out. I also talk about a visual stop on everything we've got. Okay, so basically what I do is I follow all the trades during the year, and you can see I had no losing months, which I really was proud of, because the market had a pretty good year. It was up 11%, but it had 1, 2, 3 months that were down. I did not have any. Ended the year at 151.4. Is that normal? No. that was an exceptionally good year. I did this back in 2011. In 2011, I returned 98%. Okay, and it's all based on the nightly blogs. The nightly blogs. So if you want to learn more, my offer to you today is to join me. All you have to do is go to www.optionsinfinity.com. Optionsinfinity.com. Okay, I put on a nightly video blog. I show you the charts. I show you the entry points, the exit points, why I'm doing what I'm doing. I'm looking at selling premium or theta trades. We put these on once a month on the big boys, the RUT. Used to do Apple, but Apple split, so I don't use that anymore. I use Amazon and Netflix as the big boys. And then I've got a group of 25 stocks that I follow on a routine basis, and here they are right here. I follow these every day. It's a small market basket, and I think a small market basket, you really get to understand those stocks. You're not scanning for, hey, I see a great opportunity on stock XYZ. I don't know what they do. I don't know who they are, but I see an opportunity. It's not way to trade. I mean, I could tell you what the chart for Microsoft looks like. I could tell you what the chart for Nike and PepsiCo and what they do and what their finances look like and so forth. And that's what you want to do. I put on this nightly video blog every Sunday through Thursday. Last year it returned 151.4%. Okay, you can see every trade on my website. You can go to www.optionsinfinity.com and take a look at that. Okay, well, what I do every night is I review the trades, the entry and the exit for the directional calls and puts, the monthly credit spreads, and occasionally I'll throw in some weekly options. And you say, well, how do I know what you're doing, Dale? Well, there's a 2-hour instructional video on how I trade. And it tells you exactly what the setups are that I'm looking for. And like I said, I've been doing this for 35 plus years. And it's like looking over my shoulders as I trade the markets. Now, I'm a professional. I've been doing this. I do this for a living. I better be good, because this is how I make my living. Okay? I'm going to offer this to you with a 30-day guarantee. There's no risk here. $49 a month, and that's a recurring fee. You'll make more than that, a lot more than that. As I go over all my trades throughout the month, throughout the year, I've had many people that have been with me for the longest time, because why not? I'm making the money, and it's a pretty simple thing to do. When you sign up, every night you'll get a password. You just go in and click on there. My nightly blog is usually put on around 5 o'clock. I already put it on for tonight because I knew I was going to be doing this webinar.